It was a complete financial meltdown in 2008. Ben Bernanke warned it could have resulted in 1930-style global financial meltdown with catastrophic implications. In this video, we are going to talk about events leading up to 2008, what really happened in 2008, why it happened, what was the government's response at that time, lastly, any lesson to be learned. Hi, my name is Sunny and I make videos that affect a common man financially. If you're new to this channel, please smash that like button as that will help me with the YouTube algorithm and it will be highly appreciated. We all have the desire to buy a house for which we have to take mortgage from a bank. As a result, we pay monthly mortgage payment. The homeowner signs a mortgage agreement with the bank stating the conditions. When in default, the holder of this mortgage paper repossesses the house. The banks normally sell these mortgage agreements in bundles called mortgage-backed securities to other big lenders as their risk management tool. Thus, the new holder of the mortgage agreement gets the mortgage payment from the homeowner. This gives better return than AAA rated US securities. When investors noticed, they started pouring money in this US housing-backed securities, thus creating a huge demand. These are also rated AAA, the safest possible by the rating agencies, as historically the house prices goes up over time. To fulfill the surging demand, the banks started relaxing lending rules as they were making money when they were lending and passing on the risk to the next guy. It was thought that even if some home borrowers default, the holder of the mortgage paper will be better off as now they have the ever appreciating US house. During this, Ninja, also called as no income, no job loans or subprime mortgages, become very common as the banks were clubbing these with good mortgages while the rating agencies were giving them AAA ratings which were being sold to eager investors for better returns. The subprime fever that originated in the United States soon spread to European banks. By 2008, close to 30% of all high-risk US mortgage securities were held by foreign investors. Even the insurance companies came up with credit default swaps, which was a sort of insurance against this default where AIG was a huge seller. They thought the risk is spread out and they don't even need to worry, at least that was the thought then, until everything started imploding. Because of predatory lending, the interest rates were low at the beginning while becoming unaffordable later on, and people started defaulting on mortgages historically considered very safe investment. That put more houses on sale, adding more downward pressure on the home prices, which went out of control as people owe more than the value of their homes. Now, mortgage-backed securities were dumped, making losses for holders and banks, while credit default swaps issued as insurance by companies like AIG were generating huge losses. With our modern day financial system, all banks and insurance companies around the world were exposed to these losses as nobody knew who owns what and how much in the red. The panic led to freeze in credit, which is a lifeline for any economy, due to which all big banks and lenders stopped lending to each other. The present day fractional banking system works where the banks lend out more than their deposits, assuming not all depositors will come to demand their money at the same time, using leverage to increase the return on their investment. They were not sure about what the other banks had on their books, rather they were scrambling to get their money out. All big investors started liquidating their portfolios and the liquidity in the system vanished overnight. There are many reasons why this all happened, but the main three ones are: number one, lax lending along with predatory interest rates offered. Number two, the assumption that markets and financial companies should be self-regulating. Number three, conflict of interest between big banks and rating agencies. All this resulted in 2008 financial crisis. There was a loss of faith in the big banks. The stock market, which is the reflection of people's financial sentiments, crashed, evaporating trillions of dollars of shareholder value. All of a sudden, big financial companies like Lehman Brothers, Bear Stearns, AIG, etc., were scrambling for cash as their asset to liability ratios deteriorate rapidly. Credit default swaps, mortgage backed securities, and collateralized debt obligations, which were making them tons of money before, were now worthless and responsible for losses on their books. The complicated web of asset, liability, and risk were weighing down very heavily on the entire financial system, all thanks to that housing bubble to start with. The Fed offered emergency loans to fundamentally sound banks from collapsing, started a program called TARP, the Troubled Assets Relief Program worth $700 billion, which is called as bank bailout. It was done to instill confidence in the financial system, which is the backbone of any economy, thus further stopping the carnage on the stock markets. The damage was already done as the people lost houses, jobs, and retirement portfolios, thus the widespread public outcry. The Congress passed a financial reform named Dodd-Frank Law, took steps to rein in predatory lending while putting mechanism for large banks to fail in a controlled, predictable manner. The phrase too big to fail came into prominence as Lehman Brothers failed, sending shockwaves in the financial world. Actually, there is no single culprit of 2008 crisis. The governments failed to regulate and supervise the financial system. The conflict of interest between banks and the rating agencies, the financial incentive for big banks to take on risky and unwise bets, and no real accountability for those who made tons of money that led to 2008. This is my take on the topic 2008 crisis. If you like the content that I make, please help me and my channel by liking, sharing, and subscribing to it. Thanks for watching. See you next time.